Right, let's dive straight into this explainer. Today, we're unpacking a really critical distinction in Malaysian tax law. It's one of those things that could literally save or cost you millions. We're looking at capital versus revenue receipts under the Income Tax Act 1967. Let's get right to it.
So picture this for a second. You just sold your house for a cool 1.2 million ringgit. Do you owe income tax on all that money? Well, the answer actually isn't a simple yes or no. It entirely depends on one fundamental question. Is that money considered capital or is it revenue? To figure this out, Malaysian courts rely on an incredibly elegant metaphor. Think of it like this. Capital is the tree. Revenue is the fruit. The general rule of thumb is that the government taxes you on the fruit, the actual income produced, and not the tree, which is the asset itself. And that metaphor brilliantly illustrates the strict split between the two. A capital receipt is basically cashing out the asset itself. It's a one-off disposal, like selling a piece of investment land you've held onto for a decade. Generally, that's not taxable as income. But a revenue receipt? That represents a recurring business activity, like a developer who is systematically selling off housing units. Under Section 4A of the Income Tax Act 1967, that revenue is fully taxable. Okay, but how do the courts actually figure out which side you fall on? The law doesn't explicitly define it. Instead, authorities test what your true intentions were using 6 badges of trade. They're going to scrutinize the subject matter, your holding period, the frequency of your transactions, your profit-seeking motive, the method of finance, and the circumstances of the sale. The more badges you have, like say a suspiciously short holding period or repeated sales, the more likely the Inland Revenue Board is going to treat your gain as a taxable business. Now, here is the critical twist. Let's say you managed to prove your gain was capital. You aren't completely off the hook. In modern Malaysia, the old assumption that capital is entirely untaxed, that's dead. Capital absolutely no longer means tax-free. The crucial takeaway here is that even if your receipt is deemed a capital gain, you've still got to navigate these modern tax regimes. First up, the Real Property Gains Tax, or RPGT. That levies a 10 to 30% tax on real property disposals. And second, there's the brand new Capital Gains Tax, CGT, which just took effect on March 1st, 2024. That imposes a flat 10% tax on the disposal of unlisted shares for companies and trusts. So, what does this all mean for you? Well, capital or revenue isn't written in black and white law. It's determined by the facts, those badges of trade we talked about, and your true intentions right from day one. Classifying your assets incorrectly could literally cost you millions under these new regimes. So take a really hard look at your own portfolio today. If the taxman came knocking right now, are you absolutely certain you know which of your assets are the tree and which are the fruit?